Hello and welcome to Profiles in Risk. This is your host, Tony Cañas, and today I have with me Kate Stillwell, the president of... Okay, so I just confused myself. Okay, hold on.
So I'm the founder of Jumpstart Insurance, and Jumpstart was bought by Neptune. So now,
okay.
So I'm still the founder of Jumpstart Insurance because you don't ever not be a founder. But I'm now also the president of Parametric Insurance at Neptune.
Okay, and what about Firebreak? You're also the co-founder of Firebreak, and you're still doing that too?
Yes, that's very new, and let's not introduce that until later on in the.
Okay, perfect. So let's do a do
rewind. All right.
Yeah. Hello and welcome to Profiles in Risk. This is your host Tony Cañas, and I am not in my usual place, so I don't have my fancy camera. I don't have my fancy microphone. I am kind of old style because I am out of town. I'm visiting my brother-in-law in Minnesota, escaping away from the heat of Atlanta in the summer. And today and I'm pitching a double hitter. I just recorded another episode, so I'm pretty tired. And today I have with me Kate Stillwell, who is the founder and CEO of Jumpstart Insurance, which was recently acquired by Neptune. And so she's now the president of Neptune Parametric Insurance. So I hope I got that right. Kate, thank you for joining me today. How's it going?
My pleasure, Tony. I'm really happy to be here on the show. Thank you so much for inviting me.
Awesome. And you're in the Bay, right?
Yes, I'm sitting here in my home office in Berkeley, California.
Okay, awesome. I lived in California for 2 years, one of those years in Berkeley, and had so much fun. The Bay is just a beautiful place, and people say that it's always cold. I found it to be always comfortable. So in the middle of August, I'm guessing that you've got just about perfect weather, maybe just a little bit chilly.
It's just another day in paradise. And I got to tell you, I was out traveling a little bit this summer in some warmer weather. And to come back to the Bay with the morning fog, with the nice cool weather was just such a respite.
I agree completely. Absolutely love the Bay. Heading out there for CPCU Into Risk this year in November. We'll be in San Francisco. So super excited to go back. It's been a good 6 years since we moved, and a good 2 years I think since I visited it. So it's been a while. In fact, probably 3 years, because last time I went has to have been before COVID. So anyway, very very excited to visit again. So
cool. Well, we should hook up while you're there. Well, we'll not hook up, but we should meet up while you're here. Definitely not hook up. Because I'll be speaking at Into Risk about parametric insurance.
Perfect. I will definitely be there for your session at Into Risk, and I'm very easy to recognize. I'll be there wearing a top hat and a red jacket, and I will definitely come over and say hi and thank you for coming on the podcast. Okay, awesome. So we always give the guest the chance of giving the elevator pitch. What is Jumpstart?
Thank you. Jumpstart introduced parametric insurance to consumers. And parametric, as your listeners know, means a lump sum of money is dispersed immediately upon occurrence of a predefined trigger or parameter, which is why it's called parametric. And Jumpstart's flagship product is a $10,000 payment that our customers receive after a major earthquake. And $10,000 is obviously not enough to rebuild a house in California, but it is enough to get a jump start on the recovery process, thus the name, and pay for the incidental expenses of disruption that happen after every chaotic event.
Okay, so the parametric is a very cool idea, and by the way, CPCU, when I did it in 2011, never mentioned the word parametric. I learned about it through a guest that was doing something related to parametric here on Profiles, and it's such an interesting idea. And it's taken me years to really get my head around why it's important. But I think that the example of California earthquake is maybe the easiest one to explain why it's important, right? So San Francisco got hit by the big one. What was it, 1906?
Hmm.
Right, and we've been waiting for the next one ever since, right? And now 1906, if I'm not mistaken, was an event kind of like Hurricane Andrew when it comes to its effect in the insurance industry. Both of
Hmm.
those almost bankrupted the industry, right? Bankrupted many companies. Uh, so hopefully, when and if the big one does happen, whether it's in California or in whatever other a seismic area. I'm from Costa Rica, so I'm used to earthquakes. I lived through several 6 and 7 point earthquakes back in Costa Rica when I was growing up. And so part of the problem with earthquake is it's catastrophic. So everybody's affected, right? Everybody
Hmm.
in a region is affected, and it's hard to insure. You have to reinsure it, and it's hard to adjust because if 10,000 homes in San Francisco get damaged at the same time, we just don't have enough adjusters to look at them quickly, right? So the problem is the long-term problem is were you properly covered, right? The short-term problem is what do I do if it takes 3 months for the adjuster to be able to look at my house?
Yes, and so the immediacy and the automaticity of the parametric payout makes so much sense in this world where there's so much over demand for the limited resources of labor supply
Mhm.
that are needed for adjusting an insurance claim. But there are other benefits too of parametric, and a lot of the proponents of parametric like to shout from the rooftops about the immediacy of the payment. And you don't have to have a parametric product to be able to pay right away. There's ways of financing insurance, and Dorothy is doing an interesting insurtech play with financing indemnity products, or indemnity products themselves can make advance payments. What we've found in Jumpstart is the most salient feature that our customers like best is the lack of arbitration. So yes, there's the time element. Yes, there's the knowing exactly how much you're going to get. But there's also there is no human judgment in figuring out whether or not these expenses are eligible. You just get the money. So this feeling of certainty, almost a guarantee-like feeling of knowing exactly how much and under what circumstances, and it's just completely automated.
Psychologically, it's gigantic. It's peace of mind. So for listeners that are not in California, they probably won't even know the meaning of the letter CEA, right? What is the CEA? And you haven't actually mentioned CEA, but what is CEA, and how does it play with what you guys are doing?
Yeah, thanks for asking, because it fits right into your former comment that earthquake is sort of a natural peril for parametric. So CEA stands for the California Earthquake Authority. This is a privately funded, publicly managed organization that arose after the 1994 earthquake in Northridge, California, in Southern California. It was a magnitude 6.7. It did not almost bankrupt the industry, but it did cause losses that were multiple times greater than what the industry had previously modeled for an earthquake of that size in that location. And so what happened is that the homeowners uh, carriers at that time pulled out of writing earthquake coverage. And yet at the same time, there was this overwhelming demand for earthquake coverage immediately after the earthquake. And so the public legislature stepped in and said, okay, anybody, if you still want to write homeowners, you have to write earthquake. And so then that caused a lot of carriers to step back and not even write any homeowners insurance in California. And so there became this crisis of unavailability of any homeowners insurance, much less earthquake insurance. And so that's when the state stepped in and said, okay, we're going to create this organization that can hold all of the earthquake risk and all of the participating carriers can offload the earthquake risk onto this entity, which is privately funded by premium. It's all risk-based premium, and then that's what will, by participation in the CEA, then we will allow these carriers to come write homeowners, excluding earthquake. If they want to buy, if the policyholder wants to buy earthquake, they can add it on through their homeowners carrier, but it is a CEA policy. It is administered by the homeowners carrier, but all of the risk is borne by the California Earthquake Authority. What ended up happening is that the price of earthquake coverage, because now it was risk-based, based on these better models, was many times higher than it ever had been before on a rate online basis. And so what used to be a 29% take-up rate for earthquake, because earthquake hasn't ever been mandatory for homeowners in California.
2.5%.
Yeah, is now, it's slightly more than 10%, but it hovered around 8 to 10% for about 25 years, and only recently has now edging up to 11.5%, something like that. But what that means is that 9 out of 10 Californians has no money coming to them after an earthquake. And so, but this is only one of 3 problems, right? Problem 1 is the massive protection gap of uninsured people. Problem number 2 is public aid. Some people think that FEMA is going to come bail them out, but FEMA is the first to admit that you should not rely on public funds. Whatever they do provide is going to be too little, too late for all of the time-based problems that we talked about before, this surge in demand. And the third problem is that people don't have a lot of savings, right? So compared to 50 years ago, there's more than 50% of Americans are living paycheck to paycheck with zero savings. And this is not the poorest of the poor. This is the people in our neighborhoods. They spend what they have and they make ends meet. The cost of living in the Bay is very, very high.
Ridiculous,
so these 3 factors create this perfect storm of not having enough economic stimulus after a natural disaster. And that's the biggest power of insurance in general. That's the purpose of insurance in society, right? But Parametric in particular is to engage private market capital to be deployed as economic stimulus in the time when everybody needs it at once.
Okay, there was a lot there.
Yes.
And I learned a lot. I'm a giant insurance nerd, and yet I learned a lot there. So first of all, this kind of goes step by step. I had no idea that CEA was actually risk-based, while NFIP is not, historically has not been. So interesting that while they were both politically created and politically maintained, but they exist by law, whether it's federal or in a particular state. CEA, because it's risk-based, is doing fine. Then again, see, like, they haven't been hit by a big one. We'll see how they do after a big one, right? But that's very, very interesting. I never thought about the fact that CEA was risk-based and the NFIP, the National Flood Insurance Program, is not. The other thing that really caught my attention is, why was Northridge? So if the San Francisco earthquake in 1906 almost bankrupted the industry, if Andrew almost bankrupted several companies, maybe not the whole industry, but several companies, and many companies left Florida, Andrew was the same year or within a couple of years before, I think maybe the same year, maybe a couple of years after Northridge. So why wasn't Northridge that damaging to the insurance industry? Because like the Southern California property is very, very expensive property. So I'm just curious.
A 6.7 is not a major, it's a major earthquake, but it's not the big one.
Okay? Oh, okay. So 1906 was
1906 was 7.8. So
holy crap. Okay.
Yeah, so the difference between a 6.7 and a 7.8 is about 20,000 times more powerful.
So for those of you who are listening who have never, like my reaction, that is the reaction of somebody who grew up in a seismic area and who understands, even though I don't speak math, that the Richter scale is a logarithmic scale, right?
Yes, correct.
So yeah, it's exponential. It's not linear, right? A 7 is a lot stronger than a 6.
Yeah.
and somewhere between 6 and 7, things go from scary to petrifying. And anything above a 7 is just nightmare inducing in anybody who's ever been in an earthquake. Okay, so 1906 was a 7.8.
Yes, almost an 8.
I
Yep.
had no idea. And yeah, so that is a, like, I'm guessing we have a 7.8 once in a century, in anywhere, somewhere in the planet, once in a century kind of thing.
It's a little more frequent than that, but
Okay.
in a populated area, yes, once in a century. In the middle of the ocean, once a decade.
Oh, okay. That makes sense. Yeah, big ocean. Okay, thank you. Super interesting. Holy crap! Like I'm gonna have nightmares.
Yeah. So Northridge, it was the shaking was very intense for the people who live in San Fernando Valley, but it was a gentle swaying in most of the rest of the LA basin. So the magnitude of the losses in the insurance industry was somewhere around 20 billion in 1994 dollars, which is, you know, an order of magnitude less than Andrew, and maybe 2 orders of magnitude less than what San Francisco would have been in 1994 dollars.
Okay, so going back to Jumpstart. So how is Jumpstart distributed, and has that changed post Neptune acquisition?
Thank you so much for asking, because that's actually sort of like the weakest link of figuring out how to expand Parametric beyond large catastrophe bonds and getting it into the hands of consumers who really stand the most to benefit from filling this protection gap. So when we founded Jumpstart, it was absolutely mission driven to get this product to the people. And so we went out of the gate with a direct-to-consumer model only. Not that we were excluding agents, but we wanted very much to make a statement: this is a product for individuals to be able to build their financial resilience and have the means to be able to plow back and stick it out and stay and help their neighbors when the big one comes. And the direct model is challenging for many reasons that are documented on your show and in other posts. But nevertheless, you know, one of the success stories that we had from direct is having gone to disaster preparedness fairs. We have and I'll get around to answering the rest of the question about how are we distributing now. But just as a side note, this is fun. We have an earthquake simulator. It's a trailer that we tow behind a pickup truck, and it's on hydraulic actuators, the same technology as low riding cars. And so people, and so people get in to the trailer, and we tell them to, you know, hold on, because the earthquake might happen at any moment, you know, and then the operator starts shaking the trailer, and then we experience this. The same intensity as a magnitude 7, but only for 8 seconds. So a real magnitude 7 is going to last like 60 seconds or more. And so that's why the trailer is fun and not the thing of nightmares.
And is it side to side, or is it up and down?
Yes and yes. And it tilts.
Because
so up and down, side to side the other way, and it tilts.
Okay. So for those who don't live in seismic areas, like, you probably had no idea that earthquakes can be side to side or up and down. Side to side is scary. Up and down, there are no words. Like, it's hard to even walk or run to a safe place because it affects your balance. It's absolutely awful to be in an up and down 6+ pointer. Is this movement also, does that happen in earthquakes, or is that just a feature of the simulator?
Well, if you think about waves on the earth, as the waves are moving the earth, there's absolutely a tilting motion, just like waves on the ocean.
Oh, I am so glad that I'm no longer living either in Costa Rica or in like I'm deathly afraid of earthquakes. Like I got traumatized by my childhood, basically. Okay.
So we have this earthquake simulator, and we've taken it to disaster preparedness fairs, mostly pre-COVID, none since COVID. And we get to meet the general public, and we get several hundred people through the trailer over the course of a day, and We meet lots of community members, some of whom are responsible for their neighborhood emergency response team. So it's a group of a few
That's
blocks
probably
area,
why
and then
they're
one
there at the
person is
fair.
like,
Yeah.
yeah, they keep all the emergency supplies at their house. And one of the surprising things that we found out afterward, because we called up a whole bunch of customers, whenever they sign up, we try to give them a follow-up call to learn how they found out about us, what they understand about us, where we could improve, et cetera, et cetera. And a surprising number of these calls, how did you find out about us? We found out about you from Bob. Oh, we found out about you from Jessica. These are people, they're neighbors that they trusted, that had gone and attended the disaster preparedness fair and met us there. So maybe they rode the trail or maybe they didn't. But we were astounded at how powerful this word of mouth is, especially in communities that are not that are underserved by the insurance industry. So communities of color, communities of lower income folks who first of all, two lessons. One of lesson is they really trust a sort of central neighborhood spokesperson. And second of all, they value more than the sort of the common insurance buyer. They value this lack of arbitration, so that there's no
That
sort of
is
like big company looking over their
fascinating.
shoulder and discriminating,
Yeah,
right?
so
And
they
so
don't trust the adjuster. They don't trust the insurance company. They're used to getting the short end of the stick from big institutions, both governmental and private.
yes, so
That is so interesting.
that it really affirmed and reinforced our original mission that parametric is one of the ways to build social equity, and we didn't even expect that even in the distribution there would be this social equity component of getting parametric out there.
That is absolutely fascinating. Okay, so today, is it distributed via the broker space also?
Yes, so we were
Okay.
acquired by Neptune Flood in October of 2021. Very, very great acquisition. Super happy to be part of the Neptune team. It's a small team, just like the Jumpstart team, and we really have a meeting of the minds. Flood, like earthquake, is very it's a good opportunity to build parametric, and some of the success that Neptune has had with their indemnity flood product we will be able to expand in the future to an indemnity earthquake
Okay,
product.
okay. So this is super important. So for those of you newer to insurance, for listeners newer to insurance, there's a radical difference between parametric and indemnity. Parametric is here's your payout, and go take care of what you need to take care of today. Indemnity is your normal insurance product of actually helping you repair the house. So little by little, you're moving towards a private competitor to CEA, kind of the same way that Lamparelli built Rethought to be a private competitor to NFIP.
No, I wouldn't characterize it as little by little we're moving that direction. Parametric is our focus, period. Full stop. In addition, we'll add on this indemnity as another product category and see whether or not people buy it in the same way that folks are interested in Neptune.
Is private earthquake insurance, indemnity earthquake insurance, is that a reality today anywhere in the world?
Yes, in California, about 10% of the earthquake policies are sold by private earthquake companies, and there are two major players. One is Palomar, and the other is GeoVera. There is private earthquake insurance available in Mexico to a select clientele. In New Zealand, there is private market earthquake insurance, but like California, the vast majority of New Zealand earthquake insurance for homeowners is through the EQC, Earthquake Commission.
Yes. Since it is now broker distributed and we half our listeners are brokers, why should brokers offer this extra product to their clients?
Yeah, thank you. So Neptune distributes almost exclusively through their broker and agent channels. And we didn't cut off the Jumpstart direct to consumer, but one of the things we're very excited about is Jumpstart is also now available on the agent portal and broker portal that Neptune's thousands of agents log into every day. The sales script for the agents selling a Jumpstart policy is, well, have you thought about, so since you live in California, have you thought about earthquake? Oh yeah, but it's always so expensive. I'm never going to buy earthquake. Well, lucky for you, there's a new type of earthquake coverage that pays you just this fixed amount of money, so you know exactly what you're getting, and you can use it for any reason at all, whether it's to repair damage or whether it's to pay for PTSD therapy, and anywhere in between. Oh, interesting. Tell me more. Okay, well, the cost is, in the few $100s per year for premium, and you get a payout of 10,000, and you can ramp that up to 20,000 too. And obviously, and they have to say this, $20,000 is not enough to rebuild your house. It's not total loss coverage. So it's not a substitute for a CEA policy, but it is enough to get a Jumpstart, which is why it's called Jumpstart. And so that's one sales script. And another sales script might be something like, since you live in California, have you considered, oh yeah, I have the CEA coverage. Oh, that's so great. Tell me what you think about, how you feel about the deductible. A standard deductible on a CEA policy is 10 or 15%. And it costs a lot of money, a lot more in premium to get that down to 5%. And a lot of people will say, that's okay, I can cover a 10% deductible with my savings. But on my house, and I have a 2-bedroom, 2-bath house, modest house, a 15% deductible is going to cost me more than $100,000. So people might say, well, actually, that's a pretty steep deductible.
Yeah.
And so then the agent can say, well, this parametric policy is one way to help mitigate the effects of the deductible. I mean, it's not, a 1-for-1, it's not a deductible buyback product, but it can help cover those costs.
Okay. And is it like a 5% commission to the agent, or like how does the agent get compensated for a Jumpstart policy?
Yeah, the agents get the standard commission that is offered by Neptune as an MGA, which is 12%.
Oh, okay, that's pretty decent. I mean,
Yes.
it's a small premium, but it's the right thing to do for your clients.
Yep.
And it does it definitely helps you keep the client if something goes wrong, right?
Absolutely.
Okay, very cool, very cool. I am super curious on. So I'm assuming that the product hasn't been tested yet. I'm assuming there hasn't been a single payout yet, because I don't remember a single big enough earthquake in the last few years in California. There was one in Napa while I was still living there back in 2014, probably. But I remember the images on TV of broken wine bottles. But I don't even know if it was like a 6-pointer. That's a good question. How strong does the earthquake have to be in order to get for the payout to happen?
Yeah. So each Jumpstart has its own criteria. I'm not saying not every earthquake parametric policy, like if somebody else were to develop an earthquake parametric policy, this is not the standard. It's just Jumpstart's metric. But it's the intensity of the ground shaking. And it corresponds to the smallest Richter magnitude that's going to cause an intense ground shaking is about a magnitude 6. And so we point to the 2014 magnitude 6.0 earthquake in Napa as an example. And we say, in that case, the payout zone would have been the whole Napa Valley, but it would not have extended all the way down to Oakland and Berkeley or over to Santa Rosa, which makes sense because in Napa Valley, there were work closures, there were school closures, there were
there was no damage from the
that were
Bay
left
or
on. There was,
Sacramento.
there was chaos. But the ground velocity that we use as this shaking intensity measure corresponds to the maps. And that's why it's intuitive for the customers, because after every earthquake, the USGS publishes these color-coded maps. And you see it go from like dark red to orange to yellow to green to blue. So the shaking intensity of 30 centimeters per second of ground velocity is the red and orange area of the shake map. So it's that's how we explain it. It's the red area of the shake map. I don't go into that whole explanation with consumers. They say, what's the payout zone? I say, have you ever seen a shake map? Yeah, it's the red zone of the shake map. Oh, I get it. Okay.
So is shake map does the U.S. Geological I can't remember the
Survey.
name of survey, do they call it the shake zone? Is that the technical name?
So the
The shake
product
map?
name of their map is called Shake Map. Mhm,
Fantastic. Okay.
mhm.
Good job to them naming it what the what the customer would call it. Okay.
Yeah.
Awesome. And my next question was going to be, but you just answered it basically. What was going to be, how do you finance this thing when all of the payouts happen at the same time? But I get it, right? Like you're insuring all of California, and only a small piece of it is going to get hit.
Right. So even in like a magnitude 7.8, like the 1906 scenario, yeah, everybody in the Bay Area is going to be eligible for their Jumpstart payout, but not in Southern California. In fact, in Southern California, even a 7.8, people might not even feel it in Southern California.
Yeah, it's
But
so for those of you that are not in California or that haven't spent significant time in California, from San Francisco to LA, it's an hour flight. So
mhm,
that and what, like a 6 hour drive, something like
mhm,
that.
mhm,
So yeah, California is massive,
mhm.
massive, massive, massive. In fact, uh, I lived in Berkeley, and I was the sales manager for American Modern, and my territory went like 3 hours south, and that only put me to like Visalia,
Uh-huh.
like 2 hours north to the Oregon border, and like 2 hours east to Reno.
Mm.
Right, California is a very, 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 very large piece of land. Okay, awesome. So
I want to
how?
go back and answer a
Yes, yes,
question,
yes.
one of your questions that I
Go
didn't get
ahead.
a chance to answer, which is, has the system been tested?
Oh yeah, yeah, yeah.
Have there been any triggering earthquakes? So Napa, we didn't pay out because we weren't live yet. That was 2014. We went live in 2018. But in 2019, there were two earthquakes in near Ridgecrest, California,
So
that
southern.
were big enough to trigger a jumpstart payout zone and a red zone. Ridgecrest is in the middle of the desert, sort of near Edwards Air Force Base where the space shuttle lands. It's a very low populated area. And so at the time, since we were only a few months into selling our product, we did not have any customers. We did not have the privilege of making any payouts. But within that month, we suddenly had customers located in Ridgecrest.
Uh-huh.
But the point is, even though we haven't made any payouts, the system works. We got the test of the system and all the automaticity. So that all has been
Oh,
tested.
okay, pretty cool. Pretty cool. By the way, this one is more of a psychological. So the problem with both flood and earthquake is that they happen so rarely that right after an earthquake happens, right after a flood happens, everybody wants insurance. But then a year passes, 2 years passes, 3 years passes, and I've paid premium and I've paid premium and I've paid premium and nothing has happened, and nobody's forcing me like they are with my homeowners and my auto. How do we keep them? And this might be an unanswered question. I'm asking for your thesis on how do we keep people insured for things that you pay every year but happen every 20 years, or right, that just don't happen often.
One of the things that one of the advantages of talking of direct to consumer, and especially these follow-up phone calls and the disaster preparedness fairs and getting in front of the public and talking to people and learning the perceptions of the everyday person about what they think about insurance. There's absolutely a whole category of people who think about like, I'm not getting anything out of it. I'm not seeing any return from my insurance. And then there's on the opposite end of the spectrum, there's people who are like, of course, I'm always going to buy every insurance that's available because I need, a maximum protection. And
Hmm.
most people are kind of in between of this like sort of recent memory. And if it's recent, they'll remember and they'll think they need it. And if it's not so recent, they'll think, I'll take my chances. It's not that they don't believe it's going to happen. That's a common myth among insurance nerds and people who don't necessarily aren't talking to people every single day.
Mm-hmm.
You think, oh, people just don't believe the risk. They believe the risk, but they're also, getting in their car every single day, and the risk of a car accident is always way more high than
Mm-hmm.
the risk of an earthquake, right? Even with the seatbelt on. And so people just are taking their calculated risks. So I think that to answer the question, like, how do we get beyond that? We have a lot to learn from industries like video games and dog training, which is that
Gamification.
small randomized rewards
Uh-huh.
build loyalty, and also
Uh-huh.
like airline points, right? And so
Uh-huh.
there's a psychological effect of how
Uh-huh.
can we deliver small randomized rewards, right? And interestingly, I think parametric can play a role in this too. I'm not going to say it's a silver bullet, but let's imagine that you had a policy where the major parametric payout was like after a big earthquake, but there were little parametric payouts, like flight delay parametric insurance.
Mm-hmm.
But like if there's a let's stay with the earthquake. If there's a little tremor, then you get $100 or $20, not really even meant to compensate you, because you're not really going to have any expenses,
It's
but just to prove to you that the system works, and not
I
every single
love
one,
it.
but just randomly
Yeah.
as like a loyalty benefit.
It's a
And it's
little
not insurance
lottery. Yeah,
payout; it's a
it's a little
loyalty benefit.
dopamine hit.
Yes, exactly.
Oh, so you said a lot of stuff there that's super interesting. A lot of topics that I find super interesting. Number one, gamification. I'm a big believer in gamification. For the listener, first watch her TED Talk, and then read Reality is Broken. I can't remember the author's name, but she's brilliant. She's a Harvard researcher. Anyway, Reality is Broken. My favorite on gamification. Kate, if you have a book on gamification that different than that one, I want to read it. So let me know.
Okay.
I even use Habitica to gamify my life and my productivity, because in my world in recruiting, I have to make a lot of calls to clients and a lot of calls to candidates. And sometimes it's a very long process, especially with carriers. Sometimes I'm calling on carriers for years to eventually get them to use me for a search, right? So I have to find a way to release a little bit of dopamine each time I do the activity that will eventually lead to a sale, right? And I use Habitica to do that. And finally, so hold on, you talked about gamification. You talked about little payouts. What other topic did you talk about? I can't remember what other example.
I'm still working on my mind reading capabilities.
Okay, so okay, I'll let it go for now. But anyway, gamification is very, 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 very powerful, and I love the idea of my earthquake policy refunding me a few bucks here and there
Exactly.
to prove that it is there, right? It's a hey, do renew us.
Uh-huh.
Because when the big one happens, if it happens, we are here for you. This is real. This is not UFO insurance. This is real. Awesome. So I always like that. We're kind of running out of time here. I've kept you a long time, but I always like to ask about the origin story. How did you come up? How did you realize this was a problem? And in your case, I'm looking at your LinkedIn. I see that you've got a bachelor's in civil engineering, followed by a master's from Stanford in civil engineering. By the way, University of Minnesota. Are you originally from Minnesota?
Yeah.
I happen to be in Minneapolis today, and we're heading to one of the many lakes tomorrow. So from Minnesota to Stanford for your master's. Uh, how was your first winter in California after a lifetime in Minnesota?
I wondered why people couldn't drive in the rain.
Okay.
Yeah.
And then you got your MBA from High School of Business at Berkeley. So clearly you're a civil engineer by trade, right? All the way to the master's level. So how did that lead you to realize there was an insurance problem to be solved?
Yeah. I did practice as a structural engineer, and I'm still licensed as a structural engineer in California. So working with architects to make sure that buildings are safe in earthquakes and people don't die in earthquakes. And and then I started learning more and more about the overarching theme of disaster recovery and making
Mhm.
why are we building buildings to be safe in earthquakes? Is because we all need to be able to recover from earthquakes. Okay, well, what people need more than just safe buildings to recover from earthquakes. They need good governance, they need social connectedness,
Mhm.
and they need economic stimulus. So taking this whole conversation back full circle, they need enough money to be able to make the case to stay, to plow back, and to help their neighbors. And that's a huge gap. And I had this professional crisis, honestly. It was like, what good are safe buildings if people can't afford to stick it out and live in them?
Mhm.
So we're not doing our job as disaster recovery professionals if we're not solving the rest of the problem, in particular the economics. So that's really what drove me, what motivated me to help solve this problem.
Fantastic. This has been super, super interesting. Super interesting. One of my favorite episodes ever. Absolutely. Thank you for your time. When it goes live, I will be tagging you on LinkedIn to let you know and tagging the company. Uh, I look forward to have you back in a year or two. And especially, I'd love to have you back once you guys have launched some sort of, of earthquake indemnity product to learn how that went and how that's going. And also, uh, once the significant payouts happen, once you've dealt with that, I'd love to hear the story of how that went and the people's reactions to this and also I'm really curious as to whether macroeconomically for the region, whether you'll be able to see it in the data, how what you built here actually helped California recover better than last time. Uh, so yeah, this is fantastic. Thank you so much for your time. A real pleasure having you on the show.
My pleasure, Tony. Take care.
Thank you.